Hope you had a good evening. And all of a sudden, for the first time this year, the market sparked into life yesterday in a negative fashion, led by the sell-off that was seen predominantly in the second half of the session once Wall Street got underway. And really, we'll have a talk about the reasoning behind that, and then some of the things to look out for in today's session. Because obviously at the time, a lot of questions, what was the reason behind it? Given the fact that there was no real one outright kind of headline that sparked it, it was kind of the combination of several factors, I think. And then the market kind of jumped on the move as it started to break down and pick up a bit of momentum. But a bit of a recap on the charts then of where things are at the moment. And you can see that the European stock futures, I'm looking at the DAX in the centre left, and likewise in Eurostoxx this morning, are all seen lower still. This was because there was no kind of late recovery that we've been so accustomed to in US equities over recent months. That didn't occur. In fact, we even dipped a little lower on the back of a North Korean headline that came out late in the session, which we'll talk about as well later. But it led to then, statistically speaking, well, let's just have a look at the stat here. The FT running it as their main headline story. Markets hit by the biggest decline since before Trump's election. So if you remember, even though we've seen these various macro events be ongoing, whether it be the Dutch election, the Trump situation, this movement up to record highs in US equities, actual volatility has been near record low levels when measured by things like the VIX index. But what we've had yesterday was, with the S&P falling 1.2%, it basically broke a run of 109 trading days without a drop of 1% or more. So that streak, the last time we fell, well, it was just short of the 110-day losing, or tightest within 1% range. That 110-day streak was seen last back in 1995, to give you an idea. So let's have a look at some of the reasons behind this, and then we'll look back at the charts and we can see where we kind of stand at this present point. And a couple of things that people are looking at this morning, and then there's also partly to talk about the psychology of what it means for maybe some of the less experienced guys, of how to navigate your way through the session for today. And one of the things was, yesterday what you had was very much the first half of the session, i.e. our European morning. It was generally risk-on trade, and that was emanating from the fact that Macron had performed relatively well against the first kind of critical point of coming up at the coalface against his main opposition in that live televised debate. On that snap poll, that then saw a pretty strong rally in the euro currency. The European equities were also following suit. Then you got into the US session, and one of the notable things that you've probably noticed on the TVs is this ongoing kind of investigation into Trump and his relationship with Russia, and the involvement that they had potentially, investigating with the secret services in the US. It seems to just be the only thing that US channels are really concerned about at this point. But one of the things that a lot of the market are looking at is the Trump ability to enact his campaign promises on tax cuts, infrastructure, spending, and deregulation. So what's happening at the moment is a lot of people, as it's kind of been quoted by a couple of guys in the FT this morning, uncomfortably long equities, although the head of Asia Pacific flow strategy at SocGen saying he doesn't think that these pullbacks will surprise anyone. He doesn't think a delay in healthcare reform is worth much more than 1% off the S&P. But when people were looking to sell, it gave them a reason. I think it's quite a good way, that latter part of that sentence, to suggest what happened yesterday, was that there definitely wasn't one specific headline, but this idea of implementation risk, the fact that this healthcare debate at the moment could be potentially in jeopardy, delaying then the more important side of how the market is concerned and the way it's positioned itself since the US election, which is on the back of the fiscal delivery on infrastructure spending, tax cuts and deregulation. The longer we are sidelined by his inability to inaction on the overturning of Obamacare, the House expected to vote on the repeal on Obamacare on Thursday this week, and then also this distraction of this Russian investigation situation as well is just delaying what the market has been so bid up on over the last several months. And maybe yesterday it was just a little bit of concern about that timeline was probably, I'd say, the main catalyst for why we started moving lower. Traditional safe havens then were a pretty good guide, and I would still be looking towards products like gold and Japanese yen to be a bit of a lead indicator as how the market is feeling. Obviously, as I said, European stock futures are seeing negative on the back of Asia Pac underperforming, just a continuation of that theme from the sell-off in the US yesterday. And gold is sitting up at around the highs. We can see here, I'm looking at my gold chart, we had really the big rally came soon as Wall Street really opened. We had that brief move higher on the back of following European equity move on the Macron relief. However, things quickly saw an about turn. The break in gold as well of previous highs from the prior day technically saw it spring up around $10 in pretty quick fashion. And so we're still up at these elevated levels, which if I then start looking at the yen in terms of dollar yen as well, if I just make that a bit bigger, you've got this general trend lower in dollar yen through 113, through 112 on the downside. So I'd say the market is still a little bit like a wounded animal at the moment after such a big day, the biggest volatility that we've seen in several months. The market still seems a little bit apprehensive as to where the next direction comes from. And certainly watching things like gold and the Japanese yen could be telltale signs for risk appetite, meaning that if gold starts going bid, the yen starts strengthening, then it could be then a lead indicator as towards some more movement to the downside in this equity market. Just going back though to that article about the reasoning, the tumble, as the FT say, came as inter-party divisions have jeopardized Mr. Trump's effort to repeal Obamacare, the largest initiative so far in his presidency. So Deutsche Bank looking at this as well this morning, they're saying that basically Trump has fired back at critics yesterday by telling lawmakers that the danger of you not voting for the bill is people could lose their seats. And the analysis side of things would show that losing more than 21 Republican lawmakers through the 435-seat House is likely to result in the bill not getting through, assuming all Democrats vote against. So that's one to watch given the potential implications for other reforms down the line. Obviously, if he's falling at the first hurdle here after a pretty dismal showing on his ability to sign an executive order through on the immigration front, this whole idea of the risk around what he can actually start to push through starts to capitulate, and people get more concerned about it, and then the market starts to trade more heavy in that respect. I saw a very good point as well here about we have a mismatch in timing, and I think this really sums it up. This is the chief investment strategist at State Street, and what we've seen last week, and this is why I think that the market has started to move, particularly now, because actually Trump, I would say, the risks around him have always been there. The difference is that the Fed have hiked interest rates again just last week, and I think this is why this comment about we have a mismatch in timing is very pertinent, because we're now moving into a monetary policy tightening cycle. We've seen the Fed after 2016 wait 12 months to raise interest rates. They've managed to get the next hike in between December and March, so the time frame has reduced substantially due to the strength of the underlying US economy at the moment. Now we're talking about the next rate hike potentially coming in another 3 months in June. And so we're on track for a series of more hikes to come and a bit more of a return to normality of a rate trajectory or normalization path. So now emphasis kind of turns back to the fiscal situation, and are we going to get this expected stimulative measures coming out of the Trump administration to help lift the economy further? So I think it's kind of now we have a little bit more clarity at least about how the Fed are set. It turns back now towards putting some more pressure, and people are looking to Trump to now deliver on his promise. And so that's why it's kind of brought about maybe this move that we saw yesterday. The other thing, of course, is mounting concerns over US equity valuations. I say mounting, this is definitely a concern that's been apparent for quite a long while. But more investors are starting to say that stocks are becoming overpriced than undervalued than at any point since at least 2001. This was according to a Bank of America's investor survey, which also came out yesterday. So if you're looking at multiple reasons why the sell-off, there's definitely a lot of ammunition there that you can base it upon. So looking a bit more at that Bank of America report, because this is certainly something that people will look at as a news item to pin some of the move on. And essentially what it is Bank of America send out a survey to all their different kind of clients to get a bit of a feel for market sentiment. And essentially fund managers are now saying that stocks are the most overvalued they've been in nearly 20 years. Looking at probably this one makes a bit more clearer sense, because this is valuation of equities in regions. And if you look at the US, really where we are at the moment, under the guise of a fairly accommodative monetary policy for a long period of time, a very gradual approach that we've had to getting policy off this kind of ground zero, in addition to this last blip higher here on the back of the promise of large-scale stimulus via fiscal measures, has meant that valuation of US equities is knocking it out the park compared to other geographic regions such as Europe and the UK and Japan and so on and so forth. Hence the reason why a lot of investors are starting to get a little bit of cold feet, particularly in the environment now where Trump seemingly is not being quite as effective as he was back when we were all buying the hype in kind of Q4 of last year. So that was kind of the news element of it. The other thing that is very important as well to understand here is the kind of behavioral element. And just looking at the speed of the sell-off in the S&P, you can see how really once it starts to break respective levels, like the low print from yesterday, it went lower again, it broke through S2, it kind of pushes lower again. It's almost like a bit of a snowball effect on that side of things. And then you've got obviously algos chasing momentum as well, and that pushes the price lower again. Stops being triggered on what a lot of people would have been thinking, because what has been a distinct pattern in the US equity market is buying the dip. And maybe a lot of people getting stopped out of that on an intraday strategy, and again it kind of pushes lower. Obviously in the Dow, looking slightly longer time frame here on the 240-minute candlestick, you can see that double bottom that we had from the 9th low, the 14th as well. We broke there again, another reason for a very aggressive push lower. That level also significant because it kind of marked the rally that we had from the fiscal promise from Trump. Maybe that kind of as well just drives home that point about the disappointment and the concern about his ability to deliver. The fact that this rally that we had on the 1st of March was all built on the back of this phenomenal tax plan and fiscal package that he was putting together. The markets loved it at the time. This was on that race higher in equities that we saw, the 21,000 breach in the Dow, albeit relatively short-lived. But since that point, in a bit of consolidation and breaking that range, probably also just helping push things to the downside. Now, one thing I've heard Piers mentioning it to his guys on the floor, but I think I spoke to a couple of the guys in the stage 2 part of the career program yesterday, and you really probably had one of two types of days yesterday. Either you had your best day ever in terms of performance, you managed to capture that downward move in the equity market, and given that we've not seen that type of size of move in such a long period of time, obviously it provided, if taken, a fantastic trade opportunity. So you either had probably your best day that you've had so far, or you didn't trade that move and there's kind of that feeling of missed opportunity. Now, both of those two situations can be highly dangerous if not contained and controlled in the right manner. The first being that if you had that fantastic day, obviously your feeling is of elation, almost, of a job well done, and then what can quite often happen is you then become overly confident, or you look for a repetition that you think that was such a great short that this market's going lower again because fundamentally the picture's not changed, and you keep forcing the idea of trying to short the market. The other flip reverse is if you didn't capture the move yesterday, then you feel that kind of feeling of having missed opportunity, and therefore today you definitely want to get involved because now fundamentally you understand the picture and the reasoning, and again you feel like maybe this is going to be another day where I can hit the market quite hard again in bigger size. So what you've got to do is, look at everything objectively. I mean, looking at the market and the way that things are positioned overall, you can see really the charts are telling you this market is still a little bit sensitive, a little bit fragile. The fact that I can see bunds sitting up at around highs, we're up around 60 ticks already amid some of this persistent equity weakness, albeit it's not been particularly aggressive thus far. But I can see in the bottom chart here, crude just touching on fresh lows. Obviously, if crude starts to sell off amid these bearish fundamentals that have been developing, particularly on the US output side, the question marks on whether OPEC can really seriously step up to the plate, Russia a little bit reluctant to join that commitment to cut as well. So the dynamic is definitely seems to be pressure on crude. If that starts to come under pressure, that's another weighted factor to equity. So you've just got to kind of reevaluate and just look at things and the schedule for today afresh, and then kind of trade it accordingly. Try to forget about what happened yesterday and just trade what you see. If that easier said than done, but it's something that as you get more experienced, you'll get probably more comfortable with. Okay, a few other things though that I quickly want to talk about in the briefing today, and following on from Macron yesterday and putting in a fairly strong showing in that televised debate, there's been a little bit of movement on Fillon overnight, where Fillon has essentially slipped further in France after press reports about Putin ties. So the paper saying he fixed Lebanese billionaires' meetings with Vladimir Putin. Obviously that's getting put down. Putin's spokesman now saying fake news. So it seems to be both sides of the pond coining that phrase at the moment. But Francois Fillon really has not fared well in the number and variety of types of allegations that are coming his way. This is just another one showing that in terms of Fillon now has dropped a half a percentage point, now down to 17 in the Elabe survey of first round voting intentions. In Macron up another half a point. So in the first round now, Macron's at 26%, Fillon's down at 17%. Now, a lot to be said, I think, for last minute indecisive voters going for the traditional party set, of which Fillon certainly ticks that box. But this is becoming somewhat of an insurmountable margin, you would say, on general error of margin in polls that we've typically seen. So it's looking all the more kind of certain that Macron, as is kind of the market expectation at this point, will go through. to face Le Pen in the final runoff. So just a sideline update there. I did mention as well North Korea. That was one thing that did push US equities kind of a little bit lower all the way up until the close, and kind of maybe negated that last minute recovery that we've been used to seeing in US stocks. But North Korea has drawn a little bit of attention, adding to the string of risk-off news. Reuters article suggesting essentially that North Korea is to pursue an acceleration of its nuclear and missile programs, citing US officials in Washington saying Trump is considering sweeping sanctions to counter North Korea's nuclear threat. But North Korea firing back overnight, saying that they've got no fear of US sanctions move. It's kind of a little bit of a blinksmanship going on here, but we're talking about blinksmanship with nuclear missiles, which may sound quite punchy as a headline. Let's not forget though that North Korea and this kind of highly aggressive verbal play is very much normal play for them, or normal state of play, I'd say. But it's interesting because it just goes to put more pressure on, we've not even started talking about Trump's presence and relationship with Far East nations. The North Korean situation just heightens tension with the likes of China and Japan, and net then that puts pressure on trade relations with other Western counterparts. So it's all kind of coming to the door at Trump at the moment. So hence the reason the market's kind of looking for a bit of guidance, which if Obamacare and its appeal goes against his wishes, then likelihood is it could open up a little bit more nervousness in this market to take some more profit on this kind of overvalued equity market that we've seen more recently. Okay, quick look at crude oil. This morning we've already just quickly talked about those fundamentals that have obviously weighed on crude more recently, but we have had API crude oil inventories, so we return very short time frame to the supply and demand fundamentals, if you like. And we did have APIs last night. A build in the headline crude, 4.539 million. That was against expectations of a build of 3 million. Cushing was a build just shy of 2 million. Gasoline, though, the drawdown was pretty much double expectations, a draw of just shy of 5 million. Distillates was a draw of 883,000. So much bigger build in the headline and Cushing, but a big drawdown in gasoline may have just negated some of the initial knee-jerk move. Looking at 9:30 or 8:30 now, it would be when this came out, looks like we had an initial blip higher on the headline, on the kind of mixed picture, the kind of gasoline figure. So gasoline futures shot higher, but then kind of negated a little bit by the crude and Cushing. And so net after some volatility, it was kind of net neutral. They counted each other out. But so then probably the broader directional play for those aforementioned reasons that have been in play for the last couple of weeks have kind of won out, and we continue to just edge lower here. Not forgetting that any lack of, I would say, a stimulative measure or more people disbelieving on Trump's ability to deliver arguably means then that US economy getting this shot in the arm and having much higher growth potential dissipates, and then maybe that just has a bit of a play as well on just global demand in that respect as well. So look out for those numbers. They'll be coming out later. As per the shortened time frame between us and the States until our clocks change at the weekend, those numbers are going to hit at 2:30. Quick look at the calendar for today. Very quiet overall in the morning. Not a great deal going on. The Bank of England's agent summary of business conditions, for those of you not aware of what that is, essentially the Bank of England has what they call agents that are sat in each kind of geographic region within the UK and report back to the Bank of England on specific areas, kind of northeast, northwest and so on, all the way through the country, to say this is the state of play for various different measures in that area. It's never really market moving. Some people might look at it when there's an emphasis on the likes of inflation, certainly, as we saw yesterday with sterling moving higher once again. Let's just have a quick look at that. Both major pairs you can see here just coming under a little bit of pressure as Euro's just gone through that overnight Asia Pac low. But looking at sterling yesterday, obviously a big move higher. Prices was already rallying, almost at pre-positioning ahead of the release. As we said in yesterday's session, the ONS are being investigated at the moment about leakages ahead of big economic data. That didn't seem to stop the market buying into that movement, which actually once again ended up being true because inflation did come out higher than expected.
Are they being investigated?
Well, maybe not the ONS, but they are looking into it officially now. There is a...
So our emails got through
then? Yeah, so to long story short, Piers has ruined the party for everyone who got that leak. And essentially he's a bit bitter that he missed the last big UK release, and so now he's trying to spoil the party. But essentially it was a very similar pattern. You had the pre-market movement, the number came out, it came out higher than expected, and we've busted through that Bank of England target of 2% on the inflation metric for the first time. I think it was since September of 2013. We shot higher again, and we've just kind of sat now on this 125 handle in cable. Question mark then is, we've kind of consolidated since hitting that level, and we've really seen not a hell of a lot of movement since that point, is where do we go from here? A couple of conversations in the chat room yesterday about this, and if you look a little bit longer dated and where we sit in the grander scheme of things, we're kind of bang in the middle of the range, and a very important range. That being that this was the big candle down, or the big red candle in the middle of the chart here was the EU referendum, the vote to leave. Obviously that was the big move down the downside. Then a few days after, the 6th of July, is when we eventually hit quite a key level in the futures, which was 128.0506. That level was then broken on the Tory conference at the beginning of October of 2016. And then you had the flash algo crash, if you remember, on the Sunday night, overnight in the Asia Pac session, when it was the China were out on a market holiday. That hit that price point down to 120 briefly before recovering. We then retested that close to the beginning of this year before then bouncing quite aggressively back higher. But really it's this 120 to 128 range which is very important, and we're sitting kind of relatively center of that at 125. Now really the next upside levels are not to that point, and so we're about 25, so 26, 27, 200 pips, 2 full points off that mark. And personally, I don't think that we're going to get, I think that that's going to hold in the medium term. My reason being here is that although I think inflation will continue going higher, you've already had the likes of Mark Carney try to control market positioning around that by saying basically we're comfortable, we're aware that inflation's going up. We have some tolerance for higher inflation in the short term, on the premise that obviously he doesn't want to act, he doesn't want to raise interest rates. Even though Christine Forbes bucked the trend and we saw that 8-1, that dissenter where she opted that the Bank of England should be taking immediate action, we are going through a period where inflation going up is dampening consumer sentiment, and when consumers are feeling more negative, they don't spend. That means companies don't make more money, companies then don't, it kind of kicks off this negative cycle in the economy, as we've seen with the various UK PMI readings from services, manufacturing and construction, all on the decline more recently under these elevated price pressures. Means that actually I think that you layer that over a political period of uncertainty, which is just about, let's not forget, Brexit is only just about to begin in terms of real true conversations on that measure. I think that that's enough negatives in order to weigh out and push this price lower, because higher inflation ultimately is going to put more pressure on this economy that's already beginning to show signs of weakness. So as such, that's why I don't think that we're going to blast through that 128 under just the premise of inflation going up. So something to keep definitely an eye on. It'll be interesting to see how the Bank of England try to counter verbally these measures, and I think you already had Mark Carney, and this really is kind of central banking 101. He wasn't actually, well, he was due to speak at 10 o'clock yesterday morning, but it was on something completely irrelevant. He then came out with an unscheduled comment, I think later on in the afternoon, which was specifically targeted to manage market expectations about this inflation issue, and so that the market didn't get into this mind frame that thinking the Bank of England are going to get hawkish all of a sudden just because of a one-off number. I think the actual comment he said was, we do not respond specifically to a one-off piece of economic data. Now, if we see a series of inflationary jumps from 2.3 to 2.6 to 3%, certainly that changes the game, but that's yet to be seen, and I'm sure the MPC will want to see some consistency in that pattern before that becomes more of a viable argument to raise rates more aggressively in the near term. Okay, so calendar-wise, as I said, very quiet today. Nothing really major coming out in the morning. In the afternoon, it's a kind of a similar situation. You've got existing home sales, which I wouldn't really even bother bolding that, to be quite honest. We'll keep an eye out for it, but I don't think it will be massively market moving. The oil inventory numbers could be interesting though, because if we get a bearish situation, i.e. if we had, let's say hypothetically, a big build of say 10 million, which sounds large but is not out of the norm from recent weeks, then could that then be a catalyst for quite an aggressive move lower in crude futures, and therefore be another catalyst then to spark off a bit more of another run lower in the equity market? I think oil markets are also looking a little fragile with a bias for more downside in the short term. The one thing that I would say, actually just quickly to wrap things up on oil, is if you're in a short position, I would say just be mindful of your time frames, because what is happening at the moment is the market, on the fundamental reasons and technically it seems, wants to go lower, but obviously OPEC don't want that to happen. What's happening then is when you're in a short position, I would say, whenever you're in a live position, you're exposed to risk, and that being headline risk, which is becoming more prevalent in the oil market. The lower the price goes in oil, the more likely it is that you're going to get a source comment from OPEC, a comment from Russia, a comment from Saudi Arabia. That means there's going to be periods of volatility where you're going to get a knee-jerk spike potentially in prices that could whip you out of that position. That being said then, if you're already aware of that being the case, I think you just need to be realistic then of time frames of holding that short position. If you're going to hold it for several hours, I think then there's a risk, unless the market is moving quite quickly to the downside, that you're going to get stopped out potentially on growing headline risk the lower the price becomes in oil. So just keep that in mind, because I know that was something which caught a couple of guys out yesterday. Okay, going to leave it at that. So any questions, please do feel free to pop them in the chat room. Otherwise, have a good day. As I said, try to be controlled as possible for the newer guys after what I know some of you had an excellent day. Today's a new day, and so good luck, and I'll see you in the chat room. Thanks.